Here's why Governor Tiff Macklem says another rate hike is necessary.
Recent data suggests that the restrictive stance of monetary policy is dampening household spending, particularly on housing and big-ticket items. But economic growth and employment in the second half of 2022 were stronger than we expected. And so excess demand in the economy has persisted, putting continued upward pressure on prices. Simply put, our overheated economy has not cooled as much as we expected.
Macklem says they're now pausing and watching to see if these rate hikes do their job and bring down inflation. Jimmy Jean is the chief economist with Desjardin. He's in Montreal. And Jim Stanford is an economist at the director of the Centre for Future Work. He is in Vancouver. Both are here to join us to have a conversation about where things go from here and what Canadians can expect. Mr. Jean, can I get your initial reaction, your initial thoughts on today's announcement?
Well, no big surprise on our end. We were expecting that 25 basis point rate hike, but we were also thinking that this would be the last one. And I think what the Bank of Canada told us today is that they're in a position where they're comfortable to assess the lagged effects of the moves they did last year, which were pretty significant by historical standards. We're a very indebted economy, so therefore very sensitive to interest rate hikes. But we know that the bulk of the effect is still ahead of us. So this is a Bank of Canada that wants to take stock of what's happening. It's starting to see some signs of a slowing in domestic demand in the economy. And before deciding to exert even more pain on the economy, it wants to have a sense of how this is impacting inflation in particular. So I think it's a good decision today.
Mr. Stanford, can I also get your initial reaction to what we learned and what we heard from the Bank of Canada today?
Well, I think there is an optimism out there that this was the last rate hike of this tightening cycle, but I think that optimism is somewhat misplaced, frankly. For sure, the economy is slowing down. Even the Bank of Canada expects at least a short, shallow recession. Many economists, myself included, expect something much worse. But the bank has also made it clear they're concerned about one thing and one thing only, 2% target inflation. And they aren't going to stop the tightening until they see that clearly within their sights. Now, they hope that just a slowdown or a recession on its own will get inflation back to 2%. But given the unique nature of this inflation, it wasn't caused by a domestic overheating problem. It was caused by a global pandemic and supply chain disruptions and a global energy price shock. Those things have nothing to do with the rate of interest in Canada. And I'm not convinced that a recession is going to immediately bring inflation back to 2%. And in that case, we could end up with stagflation. That's in a way the worst of both worlds, high inflation and high unemployment. And ironically, if you listen to the bank's words, they would actually keep tightening the interest rate later this year to make sure we get back to that 2% no matter what.
Mr. Stanford, that is a very grim prediction. Is that yes. What you are expecting in the next 12 months or so?
If I take the bank's words literally, they have said we are resolute in getting back to 2%. And I think they have misdiagnosed the source of the current inflation. They go on and on about wages and labor shortages and employers complaining they can't find enough workers. But that clearly was not the result, the cause of the 8% inflation we saw last year. That was all about pandemics, supply chains, shipping costs, global developments. Wages have been falling behind inflation throughout this episode. Real wages are falling, not rising. So merely hoping that a slowdown, the soft landing that the bank hopes for, or a serious recession, more like the early 80s or early 90s, which is what happened the last times we tried this, merely hoping that alone will solve inflation, I think is optimistic. And we could very well end up in a situation where inflation slows, but is still well above the 2% target. And that's what would lead the bank to increase interest rates even further, despite a looming recession.
Mr. Jean, do you share that perspective? Do you expect that things are going to go in that direction?
Well, I think this is a conversation about the bank's target, because the bank has a mandate of bringing inflation to 2%. It's deemed to be a level that is where consumers can exert irrational or rather rational inattention. So they don't have to worry too much, in other words, about where inflation is on a day-to-day basis, unlike today. Now, this is not happening. They're failing to fulfill their mandate. So, yes, by virtue of that mandate, they need to take the actions that are necessary to get there. Now, I would say, though, that in their forecast, they expect inflation at 2%. That will manifest only at the back end of 2024. So I would say they're very patient about this. I mean, if they were very, very aggressive, they would keep tightening. Certainly, they're keeping the door open to further hikes. But I think they're still very patient in waiting for another close to 2 years before they reach their mandate. And after several quarters of not fulfilling their target. So I think they want to balance ultimately the risk of causing a severe recession with the risk of letting inflation get carried away. And we know if that happens, they'll just have to act more forcefully down the road. So it feels like today they're at a place where they think those two risks are properly balanced, but of course they're going to take stock of future information.
Mr. Jean, with the risk of a recession in the year ahead, how do you want to see the federal government adjust its spending plan to deal with the slowing economy? What do you expect to see?
I think in times like this, it's important not to add fuel to the fire. So, we've said that all along last year. You want to protect the most vulnerable, but you don't want to hand out cash at large, which will just put the Bank of Canada in a more difficult situation. That's the first thing. Then I think when you're dealing with a recession, that tends to be the opportune time to go out with strong, potential enhancing investment. And there's no shortage of projects to do that. We can talk about transition, the need for affordable housing. So there's a number of very worthwhile public projects that can be undertaken when in due time. So I think now is the time for the government to really plan ahead and carefully with some smart investment to really engineer the next recovery to boost supply, which will incidentally create an environment that will be less inflationary and not more inflationary.
Mr. Stanford, I'm going to ask that same question of you. What do you want to see the federal government do with this recession looming? How should it affect their spending plan?
If anything, I would say they should speed up their spending plans. I don't accept the idea that we've got inflation because there's too much spending in Canada's economy. It was more the result of the global adjustments after the pandemic, and we've got enormous needs. In fact, Katie, you just interviewed the health minister about the needs in healthcare, and many of those public investments would actually help solve some of the underlying inflationary problems. Think about infrastructure, think about transportation, think about accelerating the rollout of green energy. Those are all things that actually undermine inflationary pressures if we make those investments and make them smart and quick. If, in fact, we do go into a recession later this year, then the case for more government spending is all the stronger. In the last 2 years, we've actually had a significant reduction in government spending. And this is an important thing to remember. At the same time, we've had rising interest rates, but we've also had our other foot on the brake as well. Fiscal impetus has been reduced as those COVID programs were phased out. So I think this will be a time actually to spend more over the next year, not less.
All right, we're going to pause the conversation there, and there's much more to discuss in the days and weeks ahead. Thank you very much, Jimmy Jean and Jim Stanford.
Thank you, Katie.
Thank you.